With the UN Climate Change Conference, COP28, starting this week in Dubai, I thought it would be useful and topical to refresh our memories about the ESG, Environmental, Social and Governance Investment Strategy. So this is a short presentation on that important topic. In the next few minutes, we're going to look at the questions such as what is ESG investing? What is the purpose of each element of ESG investing? What types of ESG strategies are there? And isn't ESG just the new socially responsible SRI investing? The problems with investing in an ESG manner, and what are your personal ESG criteria? And then there'll be a quick summary at the end. So what is ESG investing? To paraphrase the well-known economist Milton Friedman, the only duty directors have to shareholders is to maximize profits. Friedman doesn't say the time frame over which directors have this duty. Sadly, recent years have seen many corporations run with a focus only on next quarter's results, ignoring the longer-term impact on shareholder value. This has led to some spectacularly poor decisions and subsequent losses of shareholder value. To a certain extent, the ESG movement is a response to the short-termism of the last few decades. ESG investing seeks to protect shareholder value over the longer term by focusing on non-financial elements of investing. Many ESG practices are not new. They are seen as good business practice. However, with raised investor awareness, most companies highlight their ESG credentials in their annual reports. What is the purpose of each element of ESG? The E stands for environmental. Environmental investing is focused on companies that are concerned with the impact the economy has on the environment. The S standing for social. The social element of ESG focuses on how businesses interact with communities where they're based, how they treat their customers, employees, suppliers, and staff. This is a business corporate responsibility (CSR) strategy. G stands for governance. Corporate governance is concerned with the quality of management and business practices. Sadly, this is an area under which some of the biggest scandals to hit large companies have been found. Corruption, bribery, cooking the books, and other nefarious activities which damage the honest investors' holding in the company are all found under this heading. So what ESG strategies are there? We're going to have a quick look at 4 of them. Probably the oldest form of ESG investment is negative screening, sometimes referred to as exclusionary screening. This strategy excludes companies who are not meeting the investor's ESG criteria. For example, an ESG investor may exclude logging companies due to their destruction of the rainforests. Positive screening, sometimes referred to as inclusive screening, is a more focused approach than negative screening, in that it seeks companies which meet specific criteria and will not invest outside of them. For example, only companies which grow organic produce. Impact investing has an agenda. Investors use their capital to enforce change within a company or to support strategies which align with their values or investment goals. ESG integration is a strategy that seeks companies who are integrating ESG into their business plans and operations. For example, under this strategy, a multinational energy company may be included if they're investing a significant amount into researching renewable energy. A common question is, isn't ESG just the same as SRI investing or socially responsible investing? And it's true. Socially responsible investing has many of the same objectives as ESG investment. ESG is broader than SRI. Typically, SRI uses strategies like the negative screening strategies described earlier to identify potential investment opportunities. There are, however, a number of problems with the ESG investment strategy. The main problem with ESG investing is that there are no globally recognized standards for what ESG investing actually means. Therefore, it's very difficult to evaluate and compare different ESG investments. At an individual company level, not all companies provide the same amount of data to enable transparent analysis of their ESG credentials. Historically, the assumption was that investing in an environmentally friendly or an SRI way increased risk. As this form of investing has grown in popularity, this risk has reduced, but due to additional due diligence required to complete the ESG screening, costs may be slightly higher. Given that there are no globally recognized ESG criteria, you may wish to set up some of your own. When investing with an ESG screen, it's important to have a clear understanding of what you're seeking to achieve with your capital. To do this, you will need to know your values. For example, do you want to support fair trade initiative and low carbon companies? Do you want to avoid investment in companies making weapons or testing on animals? If you're planning to invest in this way, do you commit all of your capital to this strategy or just some of it? And if so, how much? These are just a few questions you may want to consider when building your ESG screen before investing into individual companies. With the rise in investor interest in ESG investing, there have been many collective investments catering for a wide assortment of strategies which save you time and effort. In summary, ESG investment as a strategy recognizes that investors often have more than pure profit in mind when they invest. They are interested in how their money is used. For the ESG investor, the use of their capital must align with their values. Unfortunately, there's no universally accepted definition of ESG or the criteria which define each of the elements of this investment strategy. I'm sure this will continue to be a widely supported investment philosophy, with the amount of assets allocated to ESG growing year on year. If you have any questions on ESG investment as a strategy or on any other financial matter, please get in touch on 050 594 5217, and thank you very much for listening.